Hey everyone, good to see you again. Today we're going to be doing a co-working feasibility study in a building in Australia. It's a 1400 square meter floor plan across one floor. However, this one's a bit different because we're going to role play a scenario where the landlord actually is being a bit forward thinking here and doesn't want it to be an ant farm of desks, super dense. They're going to come down on the rent equivalent expectation because they see this as more of a amenity opportunity, which allows you to be a bit less dense with your office desks and your open plan desks. So you can set aside some area for communal areas, right? And this doesn't necessarily need to be more meeting rooms or stuff that you can sell because the rent equivalent the landlord's expecting is lower. Think of them almost as, places that tenants within the building, not just your members, can come in and just have informal meetings, almost feel like they're welcome, right? And designed also in your floor plan in a way where it's not blocked necessarily by a receptionist that's always going to be like, hey, what are you doing here? Which is what it feels like sometimes if it's a third-party operation and not in partnership with the landlord. But it's almost like you come to the floor and you feel like you belong there, like it's cool, which I think is going to be a trend for a lot of landlord-owned flex spaces, right? Not just the commercial side of it, which is the reality of these situations, but how do we make this feel like a tenant could be up on bloody level 12, but when they come to the co-working floor, whether it's close to the level 1, level 2 ground floor area, or even on a changeover floor in the middle of the building because of the lifts kind of changing over on that floor, they feel like it's almost an extension of their tenancy, right? So what did I say? I've got my laptop here with a bunch of calcs. I've got the calcs on this side and the spreadsheet on this side. I could have got that wrong. Apologies if I have, but we'll start with, I keep rubbing stuff out. Oh, what is wrong with 1400 square meters? We're doing this one in square meters because it's in Australia, okay, everyone? So in terms of desk densities, we're going with a desk density of 8 square meters per workstation, which is super generous, super spacious when it comes to co-working. That's almost like the same density as, what have I got in my pocket here? A switch, sorry. Stuff with my sons. I was like, what's in my pocket? It's like throwing my balance offside and I'm trying to play Pokemon with my stepson. So, okay, so 8 square meters per workstation. Yeah, it's almost like a tenant fit out. You're starting to rival the 10 square meters per workstation, which is definitely more spacious, but I think that leans into not just a better experience, but productivity. Like imagine if you're in a co-working environment and you're not just like, oh my God, they're trying to fit in like literally within this 1400 square meter floor plan, 300 desks in here. What are you going to do aside from just catch colds and stuff like that from everyone else in the floor plan because of poor ventilation? It's like, oh wow, there's only 175 desks, which isn't a lot at all. So that gives you 175 desks. Now in terms, as you always know, when you watch these videos, how are we going to split those into private office desks open plan? I've actually gone 80-20 here. So we're going to have within the offices only 140 desks. And the reality in the Australian market, let's say this is in New South Wales, a lot of those are going to be dominated by 6 to 8 person offices. I rarely go beyond 15 to 20 plus. You might have a handful of those, but you really need to validate the demand for that within your market, because the larger the offices are super juicy and nice when they're full, but when they're vacant and there's no demand for it, it's just a hole in your P&L. Not fun, right? There's almost a case to make if you don't want to put the upfront money into flexible partitions for certain areas of your floor plan, that you build it to the 6 to 8, and then when you've got almost offices in certain areas that you can knock down walls for a large tenant who's going to help you pay for that because they want that area for at least 2 to 3 years. Right, almost look at it that way. So you got 140 desks in the offices. That leaves, we've got about, what have I got here? 35 desks in open plan. And I've got about 10 hot desks. Because again, I don't normally do hot desks, but remember in this scenario, spacious 1400 square meters, low desk density. It kind of leans into more open plan and hot desks, especially because we're not being pushed to hit this very high market rent target. Landlords come down on it. And by that I mean like there's like a 30% discount on the rent, right? Which allows you to play around with this a bit more. And that's good because if you've got 30% less of rent to hit because they see this as a partnership amenity / co-working opportunity, and you as the operator is really important for them still because they still need that commercial and operational diligence and discipline so that the thing makes enough money to cover outgoings, cover rent, and not just be an amenity that costs them money, right? It gives you an opportunity to mess around with the experience a lot more, which is super exciting. I'm seeing more and more of this as well. We'll get into, on the spreadsheet next to me, I've got different pricing set, as you'll see. Next to the private offices here in this row, we've got discounts set for year 2 and year 1. I've got a 20% discount in year 1 and a 10% from year 2 onwards. That's just basically, and we'll get into the occupancy theory now, because the occupancy I've set as, okay, we're gonna start at 30%, hit 85%, and that's gonna take 12 months. And to help you hit that 12-month target, we're going to discount all those private offices in year 1 by 20%. And then year 2 onwards, we're going to give you a bit of buffer, 10% of a discount to help you sell those things, right? The open plan and the hot desks, you don't need discounts. The occupancy theory is important because that first year, you need to open at that 30%, as we always talk about, because if you open at 0 to 20%, you're going to be cash flow negative because you've got staffing costs, you've got operational costs, you've probably got building outgoing obligations, your triple N costs and everything like that. So you're actually going to be in the negative in terms of your profit, which is not what a landlord wants to hear as well because they're going to be on the hook for some of those costs. You want to open strong at 30%, which is also why you have certain setup costs. And within this model, I think if I go to this dashboard, we've assumed about 112K. In setup costs in year 0. And that's think about, your pre-marketing, pre-hiring staff. I think I've got 2 on-site staff here. So pre-hire them a month or 2 to help you fill that. That's what really is the crux of the 112K and maybe 50, 60K to do a marketing campaign, your tech, all that kind of stuff. That's purely operational stuff. It's not the infrastructure that should go into your CapEx setup costs, right? Which is a different thing. Meeting room theory. How many meeting rooms have I got here? We've got 5 in total, which is a healthy amount. It's more than I'd normally like for a 1,400. There I do it again. 5 times total for a 1,400 square meter one. But because again, this is more of an amenity play, we should come up with a new word. It's not an amenity. It's not purely commercial. It's in the middle. I don't want to call it hybrid. That's been done to death. Let's sit on that. Well, by the end of this video, we'll come up with a term, okay? And it's not hybrid, but it's some sort of commercial amenity, right? But because it is moving into the, hey, we really want this thing to take care of our tenants as well, I think 5 works. And I believe I've got one of those as a podcast studio. So here we've got the meeting room assumptions here. Yeah, we've got 8-person, 1 times 8p, 1 times 6p, 2 times 4p, and 1 times podcast studio. And the reality is you can play, I've got other meeting room TBD here. This is where, as part of the feasibility due diligence, let's say you do these initial numbers to see how it stacks up. You can start messing around with what other things that you need to put in there. There's going to be a lot of areas within the floor plan of this thing that doesn't show up in your model because it's free to use for the customers, right? But the reality is they're kind of priced in your listed, your desk rates and your meeting room rates. Those are at a slight premium because you've got all these things that they can access, right? And the reality is as a landlord, the reason why they're willing to take, I'll even put here, what did I put as the discount? Yeah, 30%. The rent hurdle already here, just as a quick note, 30% discount on rent target is because they've already done their own due diligence, their numbers in their back of house to show, oh, we're reducing the downtime for all of the other floors within our building, and we're going to attract tenants, and that's going to save us X amount of dollars for our asset and increase our asset valuation because our occupancy assumption is higher overall because we've got this super amenity in there. That's where they're kind of making up for that little rent discount across the 1,400 square meters, right? Big picture thinking. So the event space I've got assumed here, we've both got an open communal one and we've also got a private. And if you're going for more of this amenity-centric one, the open communal space is really important. Okay, I'm gonna move into, I'll close this shortly and we can look at revenue and costs, but I'll move over to the simplified dashboard for now because I think I've got some of my assumptions here. Yep, perfect. Because think about when you thoughtfully design that extra open space that you have, because your density across the floor is only 8 square meters per workstation, so you only have 175 desks, you can really thoughtfully design it so whatever you have as that free use area in evenings or early mornings can double up into an informal communal event area, right? And you can book that out, or that could be thrown in as part of the member package. That's really important. I've assumed we've got a private event space as well of about a 30-person. We've got one of those. Really important. Again, this could increase, I think this could increase up to 50p. Don't go higher than that because then you're competing with like hotels that are selling wedding and ballroom venues and stuff like that. And they've got full teams selling that stuff, which will be tough. But I think the 30, 50p is really important if it's a tenant-focused amenity because you're going to do your due diligence and see what kind of tenants within the asset want in terms of event space sizes. So I think it justifies you putting it in there. Not just to tick that box, but it helps you with your assumptions. Like event spaces normally should only be modeled to be sold 5 to 10% of the time in Australia, unless you're specifically an event space provider, right? You're a co-working in this scenario. But if you're also putting something that all the tenants are asking for, you may be able to push that occupancy assumption slightly higher because you're in a building with tenants who are asking for that event space. And the reality is you could even, depending on your relationship with the landlord or the tenants, even ask, hey, how much do you spend a year on events? Like when you do your staff catering, all that kind of thing, and they might be like, hey, we spend about 80K a year on this stuff, but we have no option to go anywhere else but down the road to the local hotel. And if they go, hey, if you design something that has AV, it's in our building, we'd prefer that, you could almost assume that you could capture some of that business. So that's how I would look at it. Cafe, we've assumed no cafe because in this scenario, we don't have a ground floor presence, it's just one floor. So again, as you know how I feel about cafes, we've put a kitchenette into this model. Unless you've got like ground floor presence and a commercial kitchen to model into the building, for lots of forms of revenue to help your economies of scale for that business, that cafe is probably going to lose money. And again, if you watch this channel, the whole point of the cafe, yes, is to boost experience, but not to make margin. It helps justify your desk rates, your meeting room rates, all that kind of thing. So think of it as something that enhances the revenue potential of your other offerings, right? Extra revenue for this one. I mean, you've always got your virtual services, your mailing, and let's say this particular one is targeting professional services. You can have some offerings in there that target that particular industry bracket. What are things that you can sell to them that could help float your P&L slightly in a very small manner? Like don't rely on it. It's almost like blue sky thinking, extra revenue. I wouldn't even forecast anything other than the virtual and the mailing services and stuff like that you can package in, like parking and all that stuff. But you should always figure out, and this is almost a responsibility for your operational and your on-site team and your center manager who's responsible for the P&L. Once you start running, once you see the community you're building, figure out ways how to help them and figure out ways what they're willing to pay for that help, and then bake that into your budget moving forward. Not your forecast for the feasibility, but it almost moves into your operational budget and how you can improve year on year. Because I feel like co-working in particular, there's lots of pressures, there's lots of price matching, there's a lot of things that could mess with your budget and P&L. So what are you doing about that from an innovative, different revenue channels perspective? We've got 2x full-time staff here, we've got a center manager, and we've got the community manager / concierge hybrid. I feel like the 2x for these two are super important. It's only when you get to like 2,000 square meters plus that you've got the economies of scale to add a third headcount in. The only times I feel that you could increase this team is if you suddenly start leveraging, okay, what else is going in the building? Do you need a ground floor concierge that we can take that cost and bake it into our team? and then you've got this cohesive experience and service provision, then you can start messing around with the staffing. Or if you start going less than, the alligator mouth goes towards the 14. I may have just showed my age. So in maths in high school growing up, the way that you learn that this is greater than and less than in terms of signs is, imagine it's an alligator. The alligator is going to eat the bigger number, right? So I just had to think about that. But if it's less than 1,400 square meters, then you need to start thinking about how can I leverage other staff within the building, systems and stuff to bring those costs down. Interesting thing about this scenario is the spec suites, okay? Because this is a very amenity-centric floor plan. So this is the floor, and normally, say this is the entrance with the facilities. Normally you get lots of offices. Say you only have offices around here, and you've got all of this area here as amenity because you've got a lower desk density. Part of the reason for that is because it's tenant focused, right? But then your staff, not only will tenants come to use that, but your staff can then go to all these other floors that are spec suites and service them, right? And that could be a laundry list of services. That could be concierge. That could be community because they've got spaces within their suites that they need activation. That could be, that could be tech and laundry, not laundry, tech and cleaning, all this kind of stuff. The whole point of the spec suite model is that if you're going into the building and the landlord is already thinking about, we don't want the co-working floor to be super dense, how can you take care of our tenants? There's an opportunity for you to argue, well, let's also service the spec suites and offer a spec suite with a service offering, right? Which I think is an opportunity for you to generate more revenue for your co-working business, but also expand your scope and also de-risk your existence as an operator, right? You should be figuring out how to help landlords in this scenario. Rent hurdle, we've got a rent hurdle here which is relatively low. The rent hurdle here, what do we have? 161. 33. Okay, so the rent hurdle is 33% in this scenario of the rent. 33% of rent, but the rent has already taken a 30% discount because it's an amenity, which is why we went from, bear with me, we went from 700 to 490, which is the target, to 33% of that, which is the rent hurdle for this scenario, which is $161 per square meter. So that's how we came to the rent hurdle. And essentially whether this is guaranteed depends on how you do the deal with the operator. This could be the guaranteed rent and then everything else is made up through the rev share profit share arrangement, or it could be an equivalent that is paid first as part of the waterfall payment structure. Really depends on what you're doing there. Okay, and then the management fee for this one, I keep referring now to the annual summary here. Excuse me, I think I've got hay fever or something right now because my nose is so itchy and it is so annoying. I'm the most sensitive person ever when it comes to hay fever. I really hope I haven't passed that on to my son because it's the most annoying thing ever. We've got 7% revenue share and 8% profit. So in total, the operator in this scenario, because it's a smaller scope, is earning by year 2, 110 plus, let's call it, let's just add these two together, shall we? Yeah, 150K by year 2. And then you would add spec suites with the service offerings, all that kind of stuff if you negotiate that into your deal. And the landlord's target here we can see would be targeting if they took the discount of their rent to $490 with escalations, and I've assumed escalations to be in this scenario, trying to reconnect. Whoops, hopefully that reconnected. 3%. So with 3% escalations, it's 504. We're slightly missing. So we're slightly under the rent target. The delta is about $10. So actually, to role play now, if I was actually doing this feasibility, what you would do here is not go into your detailed model and mess around with pricing and just boost it, or see if you could fit in more desks to like kind of fudge the numbers till you get into the green, so the delta's higher. In this situation, I would have an honest conversation with the landlord. I would be like, going in super conservative with all our assumptions. We're just shy of the market rent equivalent target that you want, even with the discount. What we can do is we can try and increase the density of the desks, or we can keep it as is and we can budget for this scenario. I think you got to be open with those conversations and not start changing things, because then you impact what you're trying to achieve in the first place. You know, the experience. And the reality is the denser you get, then the more you move away from experience, it hurts your occupancy projections and your numbers. Because everything looks fine on a spreadsheet, but if you start messing it with the wrong way, I think that's when it starts getting a bit dangerous. And then you're gonna come into problems after you build the thing, and year 2 and year 3. So it's kind of like, oh, this is future Tashi's problem in 2-3 years, because it'll take a year to build the thing, and then it'll take a year to ramp up. And almost everyone hits their occupancy targets in the first year, because you're flinging out discounts that you've budgeted in. But then in year 2 and year 3 onwards, you're like, hey, I'm missing my budget. And you're like, oh, it's because you made all of these shortcuts while you were forecasting this. And yeah, you might figure it out when you're on the fly, but why would you want to be on the back foot then? And I think a landlord as a partner would respect these transparent discussions you're having, rather than just putting a healthy spreadsheet in front of them every single time. I think I'll stop there. You know, normally we go into the CapEx and how you deal with that. It really depends on your market and what your tenant incentive contribution is. So a lot of the time in Australia, you get a significant incentive if you're an actual tenant taking space. You know, it could be 30 up to, you know, I've seen some stuff as ridiculous as close to 50%. And a landlord sees that as, okay, in theory, if we were going to fund this build, the tenant incentive would go towards that. Albeit more recently, because landlords are trying not to fund the majority of the fit out for even their local tenants, if this wasn't a management agreement deal, you may need to figure out how to approach that a bit differently, because they may prefer to only contribute, say, 30% of that incentive to the fit out, and the rest abates the rent. So how do you deal with that as an operator when you're having that upfront conversation? Okay, well, I'll stop there. I'm trying to do these videos slightly more concise, a bit shorter, because they've been going on the long side. But let me know, please let me know in the comments if this is still helpful. The next video I do, I'm gonna try with each of these videos to help with variety, show different scenarios under hypothetical conversations with landlords, or conversations that I've had, and different markets. So I think someone in the comments requested Hong Kong as one of the next ones, so I'll do that. So please, in the comments, let me know, and I'm more than happy to oblige. So thanks for listening. Great.